Our agenda today is going to cover the CARES Act, as I was just mentioning. In addition to the PPP that's gotten a lot of attention, there's been a whole bunch of tax changes that have come out over the last few weeks here, and ongoing regulations and interpretation are still coming down the pike. So we want to get everybody on the call today, you're well up to speed on what's going on with that. We'll cover the Families First Corona Response Act, which covers some of the mandates for employer leave with sick leave and FMLA. And then, as I mentioned, we'll get into questions. The first thing that's important that everybody's probably wondering is the July 15th tax deadline. So even this has kind of bounced up and down the last couple of weeks here. Good news is both filing and paying are now delayed till July 15th. First, when it came out, it was only paying, not filing. There was a lot of confusion. Right now, what you need to know is 7/15 is the deadline that they've extended to. Most of the states, last time I checked, have gone that way. I think in the Northeast, there was a couple of strangleholds that weren't fully on board yet because of nuances of their legislators. But New York, Connecticut, and several others, Maine, are already on board there. There's also no limit. When this first came out with the tax deadline, there was $1 million limit on taxes that you could defer. Those limits are gone. They adjusted that as well. Just this morning, they clarified for seniors that you don't have to file a tax return if you haven't been filing because of the low income threshold to get your checks that we'll talk about here in a second. The HSAs and IRA contributions, you can also have till July 15th to make those contributions. So that's important too. If you want to put in money to your IRAs or HSAs, maybe try to get in some investment funds while the stock market looks a little bit down here. First quarter estimates that were normally due on 4/15/2020, those are also been extended to July 15th. The second quarter estimates in June, those have not been extended. So the estimate extension there is only for the 4/15/2021. The other thing that a lot of people are asking about is, okay, how much money is coming my way from these rebate checks? And this chart here is a really neat chart that good job with explaining this. In its simplest term, if you make under $75,000 as a single person or under 150 grand as a married filing jointly couple, you're going to get either $1,200 or $2,400 respectively. So that's the baseline there of what you're getting, plus an extra $500 per child, as defined in the child tax credit. For people that begin to get over those thresholds, the way the phase outs work are a little bit nuanced because it depends on how many kids you have because of that $500 credit that they're going to give you. So you can see here on the chart where those phase out ranges begin to occur. But if you're under, again, if you're over $99,000 as a single individual, you're completely phased out. There's no check for you. If you're over $198,000 as a married couple and no children, you're also phased out. So a little bit of a nuanced range there, depending on whether or not the taxpayer has children. And those checks should be coming out in the next few weeks here. Those are, I know, based on your 2019 tax return, if filed. If you have not filed your 2019 tax return, they will look at your 2018 tax return. The important thing there is there could be some tax planning opportunities because if your 2019 income was going to be a lot higher than 2018, you may want to delay filing your 2019 return. Likewise, if that's reversed, it may make sense to file later or sooner. These checks coming, these rebate checks, are intended to be an advance credit on your 2020 tax return. And the important thing with this is the language of the law appears that it's written in a very taxpayer-friendly way, where a taxpayer will not owe money if 2020's income is higher than, let's say, 2019's income. So there's no apparent clawback when 2020 rolls around for taking back what you got in 19. It's written very taxpayer-friendly in that regard. A lot of farmers have the opportunities to think about tax planning, as we'll see here with 2019. So looking at 19 and 20 and tax planning your income, to benefit from these rebates and get the next credit possible, I think is very important. You need to work with your tax preparers to make sure your rebate checks are the most they can be. The other thing that the CARES Act touched on with regard to retirement accounts was a few different things. Number one, the 10% typical early withdrawal penalty, for qualified retirement accounts has been waived. You can take up to $100,000 from your retirement account in 2020 if you have a corona-related distribution. And what does that mean? You've been diagnosed with COVID-19, you've had a spouse or dependent that's been diagnosed, or you've experienced financial distress as a result of a job loss, a quarantine, perhaps a reduction in hours, closing or reducing your business hours, unable to work due to child care. All those things there would allow you to take a $100,000 distribution penalty-free. If you do that, you have a 3-year period over which you can repay that amount as sort of, think of it like an interest-free loan as a tax-free rollover. You wouldn't pay the income tax if you do that. But there is some tax planning involved there too, because you may want to pay all the tax up front, which you're allowed to because you can opt out of the 3-year period, because maybe tax planning shows you that 2020 you might have some tax write-offs to offset against the distribution. You may want to pay the tax up front because you can reduce that taxable income with perhaps some business losses, which, as we'll see in a few slides, they've proliferated the ability to use up net operating losses and other things that are business friendly. They've also increased the amount of loans that people can take from their 401ks, the retirement plans there. It used to be $50,000. That's now bumped up to $100,000. And for people who had pre-existing loans there are also nuances as far as, those payments can be deferred for a while, up to a year, and some other navigational tricks there. The meat and potatoes, I think, in my mind, as I think about businesses and what's in the CARES Act as far as the provisions that affect farmers, is the net operating loss rules, the excess business loss rules, and the interest limitation rules that apply to some of the larger customers. So remember, net operating losses, right? If you have a business loss, under the Tax Cuts and Jobs Act, they pretty much got rid of those favorable farming losses to go back 5 years. Farmers only can have a 2-year carryback under the Tax Cuts and Jobs Act, where other taxpayers got to carry it forward in perpetuity. The CARES Act gets rid of these tighter rules as TCJA implemented and brings back the more favorable rules. So right now, for tax years 2018 through 2020, there is a 5-year net operating loss carryback. So they want to, again, expand the ability to use net operating losses by having those be able to be carried back and forth. I know a lot of taxpayers, some that I worked with in 2018, were really negatively impacted by the tightening of these NOL rules. Taxpayers should work closely with their preparers to revisit, potentially those situations in 2018 where you were being limited in those cases. The NOL rules, they kind of dovetail with the excess business loss rules, which, if you recall from the Tax Cuts and Jobs Act, basically what that did was it said, if you're a married couple, let's say, you can only take $500,000 of a business loss and offset it against non-business income. So think of like, if Dario Arezzo had $1 million of dividends, he couldn't take a $1 million farm loss against that. I'd be limited to $500,000. Those 461 excess business loss rules have also been removed. So now there's no limitation on what I can offset with my net operating loss there. And again, that's for 2018 through 2020. Come 2021, the excess business loss rules will get back in effect until the end of 2025, when, as most other things that the Tax Cuts and Jobs Act enacted, expire. So for those 5 years from 2021 to 2025, those harsher limits are back in place. And again, I would just say, I always view it as taking a proactive approach with customers, where if we know these rules are going to tighten back up in 2021, being aware of when we recognize income could become important as far as optimizing tax planning opportunities. The last one that's changed there, as far as limitations that have gotten more expansive, is the 163J business interest limitation deduction. And that essentially applies to taxpayers with average annual gross receipts of over $25 million for the last prior 3 years. People that were in that category had their interest deductions limited to business interest income plus 30% of adjusted taxable income plus floor financing. The TCJA, for those taxpayers who are subject to that, that 30% is now up to 50%. So they've expanded the amount of interest that higher grossing businesses can deduct under 163J. An important point to know about 163J is they did make a farming exception there. So even large farms with those thresholds of gross receipts have a rule where they can opt out of that. However, the trade-off in those cases for those farms is that they have to use a slower depreciation method. So again, it's always behooves us to do an analysis to figure out if electing out of those rules, limiting interest makes sense. If you have to have a slower depreciation, you always got to run those numbers to make sure you're getting the best advice there. Corporate AMT credits have been accelerated as well. So for corporations that had AMT credits, because the AMT kind of went away with the TCJA, those credits for corporations were going to be able to be recouped over a several-year period. Those have now been accelerated where we can recoup those. Now we don't got to wait over that multi-year period. And the last thing I'll mention that's not on the slide for perhaps like a winery or somebody who's got qualified improvement property, as they call it. Pretty much, if you're making improvements to a commercial building, there was a drafting error in the Tax Cuts and Jobs Act that didn't make those improvements eligible for full expensing of using like bonus depreciation, where you can write that stuff off up front. They fixed that so-called retail glitch, as they term it, so that people making improvements in commercial buildings can take bonus depreciation on those improvements. So a lot of expansion, as you can see, for the businesses of being able to utilize these loss provisions because we have these huge opportunities with Section 179 and bonus depreciation, where pretty much farmers and business people can write off almost everything that they buy these days. And the point of these restrictions being loosened up on the NOLs and stuff is to be able to use those tools to our advantages to free up what otherwise would have been taxable income to minimize taxable liability and increase cash flows. A couple small things that they've done for 2020 as well is they're going to allow people a $300 above the line deduction for donating to your charitable organizations, churches, other places of faith, 501c3s. They've also laxed up individual charitable contributions. You can see the numbers on your screen there. People that donate to charity can now go up to 100% of AGI to claim those donations, 25% for corpse. And then food inventory, there was also a lower limit there for people donating to food inventories. That number's also gone up to 25% as well. For people on the call that have student loans, it's important to know that the CARES Act did do some stuff here where payments have been delayed through September for federal student loans. That's good news there. They've also allowed for employers who are looking to do things for employees. The Act provides for employers to contribute up to $5,250 annually towards an employee's student loans without having that employee recognize that contribution as income. That goes from now and before January 1st, 2021 year. So employers can pay some student loans for employees or give them the money to pay that, and that's not going to be taxable income as far as that goes. The other part that's neat with the student loan provisions here is that certain loan forgiveness time continues. So there are some programs out there for people like the private student loan forgiveness that kind of, if you're working for 10 years in a qualified endeavor, those loans are forgiven by the government. This suspension of making your payments doesn't count against you there. So no worries there about if I suspend my payments because they're delayed, will I kind of hurt myself with these private student loan forgiveness timelines here. Nothing to worry about as far as that goes. That's still going to be fine. The employee retention credits. This is an important slide, particularly as Chris mentioned, as we talk about at the end of the webinar here on the PPP stuff, and again, more extensively on the webinar next week. There is also this part of the CARES Act that's known as the employee retention credit. And what I want to note up front here is, and we'll see at the end of the presentation too, this credit, you can't take this and the PPP loan. They're kind of one or the other, as we'll see. So I'll explain what this credit is and how you can qualify for this. This employee retention credit, and keep in mind that right now I'm not talking about the stuff that has to deal with sick leave, family medical leave. This is a separate credit part of the CARES Act. How this works is you get 50% of your wages per employee up to 10 grand. So take a $5,000 a credit per employee, for the wages paid, through the end of the year here, starting from March. Who qualifies for this? It's a little harder to qualify because farms are essential. So you have to have one of two things happen in order to qualify for this. Number one, your business has to be interrupted, which means basically the government has issued an order saying, you're not essential, you have to stay home, blah, blah, blah. I would guess most farms are not going to fall into that one because farms are essential. Now, there has been some things depending on, I saw something in New York State, for example, with horticulture, where that may not be essential anymore, that's been a little bit of a moving ball there. But most farms are going to be essential. So you can't qualify under business being interrupted. The other way to qualify for this is 50% of gross receipts decline. And I'll show you what that looks like on the next slide here. But there are different rules here as far as whether or not you have 100 or fewer employees. If you average more than 100 employees in 2019, then the qualified wages I'm talking about will not be for services provided due to either full or partial suspension of operations or decline of receipts. So basically, it's got to be people that are not doing those two activities there. If you're under 100 employees, then any wages paid to any employee will be able to count here. So how do you qualify? So you're saying, okay, I'm a farmer, I'm essential. So what does this gross receipt decline mean here? And the next slide right here, I think, does a good job of showing what that means. I made an example here of BKM farms and how this employee retention credit would work. So you have to fall under 50% gross receipts, quarter over quarter. So you look at this hypothetical example of 2019 revenues versus 2020 revenues. You look at quarter two right there. Quarter two, this Farms LLC has $40,000 of the revenues. That's under 50%. They're going to be eligible starting quarter two for this credit. Look at quarter three. Quarter three, they're also, they got $75,000 of revenue. They're also going to be able to qualify for this credit, again, which is a credit for the employer portion of the Social Security taxes here. But look at quarter four. This credit stops at any point in which a business reaches over 80% of revenues in the prior quarter year. Sorry, you don't pass go, you don't collect $200 in Q4 year for BKM Farms because they hit $85,000, and once you get to 80, you no longer count. And so as I'm thinking to myself, as I'm reading this stuff here, going, okay, maybe is there an opportunity here, working again with tax planning here, to maybe defer income? We may want to manage Q4 and push income into next year to qualify for Q4 for some tax credits here. So again, a lot going on with all these credits and stuff and all these NOL rules. I think if you're thinking to yourself, wow, there's a lot here. I agree. It's going to take a lot of proactive tax planning this year to be able to navigate some of these things. But remember, the employee retention credit here, so even if you do qualify because maybe you're that rare exception where you are interrupted and shut down, or you're under 50% gross receipts, this credit does not jive with the PPP loan. So you can't do it if you do the PPP loans. And that's an important point here that as I'm reading stuff online, I see a lot of stuff on these loans. But you got to also make sure that the other things out there for you, that you're aware of them so that you can make the best decision possible for your individual circumstance. These employee retention credits, you can receive them quarterly. So you don't got to wait till you're all done with the year to get these. Employers can access that the withheld tax is required to be deposited or request an advance from the IRS. So what does that mean? Good example here, I was able to look from the IRS website is, okay, let's say we have qualified wages for somebody who's paying 10 grand. As I mentioned, our credit's 50%, so we got $5,000 there. Let's say our normal required deposit is going to be $8,000. So what does this employer do? This employer can keep $5,000 of the $8,000 they're required to remit, and as long as they pay the remaining $3,000, again, no penalties there for keeping that amount there. And the $5,000 that you accounted for, that you've kept, that's going to be accounted for on your 941, 943. The IRS will be putting out instructions on those quarterly reports and all that good stuff that we're waiting for. But that's how that mechanism will work as far as, what that looks like from a chronological standpoint of getting these credits. But let's say that maybe there's not enough where you don't have enough to cover those credits. This example covers that. So what would you do here? Let's say you have $20,000 of qualified wages. The credit amount is 10, and you're required to deposit $8,000. What you can do in this case is you can keep $8,000 and then file Form 7200, which basically you file this form and then they give you the money that you are owed to make you true up to that $10,000 credit amount. So that's important to know how that works. If somebody files the Form 7200, they'll need to reconcile these advanced credits and its deposits on their quarterly reports, as I mentioned, to make sure that they don't have any underpayment of federal employment taxes for the quarter. So there'll be some quarterly truing up as well, and again, more guidance coming out and instructions that the IRS will tell us how to navigate these forms. I assume right now they're in the process of updating all these forms to comply with with these provisions here. Another part of the CARES Act is the deferral of payroll taxes. So employers, as well as self-employed individuals, can defer the 6.2% employer share of Social Security taxes for their employees. Under this provision, these deferred taxes must be paid over the following 2 years. So you pay half of them 12/31/2021, and you pay the other half by 12/31/2022. Again, an important point here. So as everybody who's thinking about PPP stuff here, make a note. This provision will not apply to taxpayers who have loans forgiven under the Small Business Act or another part of the Act 1109 that deals with some Treasury stuff. So there is interplay again here with some of this loan forgiveness stuff that you, I think, should be aware of. But again, this could be an important tool here. As I think about tax planning, a lot of farmers, a lot of people, members of cooperatives, they get these big 199A pass-throughs, and oftentimes those pass-throughs with proper tax planning are so big that we're not paying any income tax, but we're still paying self-employment tax. So you perhaps some good ways to defer some of those taxes into later years to, again, increase cash flows during these tough times here. I'm going to move in now to the Families First Corona Response Act. This is effective right now to the end of the year. So what is this? Most employers, if you're under 500 employees, you have to provide paid sick leave as defined here and expanded family medical leave. There is one exception to that, as you can see here on your screen. And the important part of this slide is all three of these things have to be met in order to be exempt. You have to be under 50 employees, and the leave being requested is because the child's school or daycare is closed, and they say authorized officer, quote unquote, so the person in charge of the business has to determine that one of three viability concerns is met here. So what would that mean? What's a viability concern? As I think about what you're seeing on the screen is, if you offer this leave, basically your business will essentially fail. So number one, expenses would exceed revenues and cause the business to cease operating at a minimum capacity. You have an absence of employees. If they take the leave, would be a substantial risk to your business, or you have insufficient workers to perform essential tasks. So again, going back to keeping these three viability concerns in mind, you have to be under 50 employees. The leave has to be requested by your employee because the child's school or daycare is closed, and then you have to have one of those three concerns here from a viability standpoint that I mentioned. I tried to make a slide for everybody today because, as I was reading this stuff, it was a little hard to kind of continue to follow all the basic words here. So I wanted to kind of put a side by side on these two different provisions of these leaves. So you can see side by side here, we have the Emergency Family Medical Leave Expansion Act, and we have the Emergency Paid Sick Leave Act. They're both effective from now through the end of the year, both effective for employers under 500 employees. You're only exempt if you meet the three things I talked about: under 50 employees, leave requested for the child, and an authorized officer determines viability concerns. The big difference between these two programs that you're probably subject to is the employee eligibility. So the Emergency Family Medical Leave Expansion Act is after 30 days of employment. The emergency paid sick leave is immediately. So important distinction there between these two programs. The employee event. So what qualifies for the Emergency Family Medical Leave Expansion Act? You're unable to work or telework due to a bona fide need to care for a child when that child's school or daycare is closed. An important point to note here is that all FMLA now is not paid leave. It's just that bullet point above. This Emergency FML Expansion Act deals with only that part of the child's care being needed there. The first 10 days of the Emergency Family Medical Leave Expansion Act are unpaid. The point there is basically, as I'll talk about now on the right side of the screen, the thought process that people are going to use the emergency paid sick leave for the first 10 days, and then they're going to hop on, if they're eligible for the Emergency Family Medical Leave Expansion Act, they'll hop on it back then. So you can see the duration of the benefit there. You're below there, 12 weeks, first 10 unpaid, and then up to 80 hours. So 10 days of the emergency paid sick leave there. But I thought this was a nice way to present this morning, because they look pretty similar, and they are. But you can see the main difference here is the employee event. The Emergency Paid Sick Leave Act has a lot more things that count for it. So for the Emergency Paid Sick Leave Act, you're unable to work or telework due to being in isolation or quarantine order. You're advised to self-quarantine from a medical professional. Perhaps you're experiencing symptoms and seeking medical help. You're caring for a person subject to isolation, quarantine, or who's been advised to self-quarantine. Number 5 there, you're caring for a child whose school is closed. So again, look at number 5 there and compare it to the first bullet point in the left column with the family medical leave stuff. Same thing there. So that's kind of the uniform criteria there. As you think about what's the same across both of those is number 5. And that's why the first 10 days are unpaid with the Emergency Family Medical Leave Act, is because those first 10 days are covered under the Emergency Paid Sick Leave Act. That begs the question, what does work or telework mean? You must be unable to work or telework. So if your employer is permitting you or allowing you to work from outside the home, if your normal wages are being paid, and if you're not being compensated, then you're still working or teleworking under what's going on right now. And obviously you're still working, so you're not part of those programs there. The amount of pay for this is the employee will receive the greater of their regular rate of pay, their federal minimum wage under the FLSA, or your applicable state and local minimum wage. And if you go to the Department of Labor website, again, which will link to all this stuff, and we have on our Knowledge Exchange site at Farm Credit East with a lot of resources that you can go to and find all these federal and state links here. Your regular rate of pay is going to be the regular rate over that period up to 6 months prior to the date in which that person takes leave. If that person's not worked for 6 months, then the regular rate used to calculate the leave is the average of your regular rate paid for each week that they've worked for the current employer. So again, and then it goes into if you have odd situations there, you kind of have to work through with the employee, figuring out what's the amount that should be getting paid. Like with part-timers, they're also entitled to leave here based off of the numbers of hours worked in a prior 2-week period. So for part-timers, you have to calculate the hours of leave based on the number of hours that employee is normally scheduled to work, et cetera there. What is the amount of sick leave paid that people are going to get? So that the max payments that people can get, you can see either $511 per day or $200 per day. And that's going to be based on the reason that you're taking the leave. If the reason is quarantine isolation, your regular pay is what you're going to get with the maxes there of the $511. If you're self-quarantining because you've been told to do that, it's also your regular pay up to the $511 max $51.10. Or if you're seeking a diagnosis because you're experiencing symptoms, again, regular pay $511 up to $51.10. If your sick leave is due to caring for somebody else who's been quarantined, isolated, or self-quarantining, Then it's 2/3 of the regular pay, up to $200 a day or 2K max. Caring for a child due to closures, 2/3 regular pay, $200, 2K max. And then similar conditions as specified by the government there. It talks about, as you read the rules, I guess, my takeaway is if the government decides that some other things will count for this, they'll plug it into that kind of catch-all category as that pops up, and that'll be 2/3 regular pay, $200 a day, $2,000 max here. The Emergency Family Medical Expansion Act, as I was just going over, again, remember, it's up to 12 weeks family leave. First 2 unpaid because of the sick leave stuff. If you're unable to work or telework, as I mentioned already, 2/3 regular pay after those 10 days have expired. So $200 per day, $10,000 max. And then for an employee who's taking the 10 days of sick leave plus the emergency FMLA stuff, they're not going to receive more than the $12,000 total there. As far as max benefits allotted. The good news is for employers is that the eligible employers are entitled to take a fully refundable tax credit equal to the required paid sick leave. This credit includes the employer's share of the Medicare tax imposed on the wages, and also its allocable cost of maintaining health insurance coverage for the employer or for the employee. Notably here to keep in mind, the eligible employer is not subject to the employer portion of Social Security taxes imposed on those wages. I'll say again, the eligible employer is not subject to the employer portion of Social Security taxes imposed by those wages. And then as we get these credits in, typically, generally, if you're familiar with tax laws, tax credits are going to be taxable income, so you get credits back if they're above and beyond taxes owed. Any refunds generally are always going to be taxable income. They do make a note where if you owe a debt to a government agency, they're going to reduce your credits because they're going to take those credits and give them right to certain government authorities there in those cases. Self-employed sick leave credit. So for people that are self-employed, you are also going to be eligible for sick leave credit. And there's a formula here on the way this works too. And it's you can see on the screen there, it's the lesser of the $511 per day for that 10-day max for that self-care, or $200 per day if you're caring for somebody else, or either 2/3 or 100% if you're dealing with yourself there and isolating yourself of the average daily self-employment income. And the way they get into what that means is you look at your net earnings from self-employment for the year divided by 260 days. So for self-employed people, you work with as this credit comes on board, there'll be some figuring to do. But the good news is that these credits are going to be claimed on the income tax return, so your tax preparers will be able to help you out navigating these things for self-employed people. Self-employed sick leave credit. Again, the number of qualified leave days for the sick leave times the lesser of the $200 or average daily self-employment income. So if you're taking, again, the expanded FMLA credit there up to 50 days, max credit's going to be $10,000, $200 per day. And the self-employed credits are claimed on the income tax return year. So we're going to claim these again on the income tax return. Getting into some of the tax credit interplay here, and again, this is important again as you think about the SBA loans and you think about how some of this other stuff that I mentioned gets into the weeds here. If you're claiming the employee retention credit, as I mentioned, you can't claim the small business interruption loan. You can't claim the same employee retention credit on the FFCRA tax credits, the ones that are due to the leave, on the same wages. But if they're on different wages, you would be able to. If you're a taxpayer claiming work opportunity tax credits, you also can't double dip with the employee retention credit and the work opportunity tax credit there. The deferment of Social Security taxes, as I mentioned earlier, with the 6.2% being able to be deferred. Again, for those looking at all options here, you can't do that. And have that small business and their loan stuff forgiven. So an important interplay here with people looking at all these things that are out there for staff. I'm going to turn now briefly to the unemployment compensation year. And I'll just note up front that unemployment is a state-specific program, so each state's going to have their own kind of stuff out there. The Farm Credit has, again, links on the website to different state authorities here, but it's a state program that deals with the unemployment insurance. Even though federal money is given, it kind of runs through the states here. But the thing I want to point out here is what they did as part of this bill is they've created pandemic unemployment insurance, and it's available to people not eligible for unemployment insurance normally. So think of self-employment people, farmers, people that are self-employed now are able to qualify under this pandemic unemployment insurance. They wanted to make sure that this relief was available to people, in those categories. That's really great that they did that. They've also added a kind of a 4-month two-step provision here, where there's a separate part of this thing for people getting unemployment insurance or pandemic benefits. Is the first 4 months are an extra $600 per week that you could be eligible for. So again, they're maxing up the benefits for a few months here under this program. There's going to be 13 extra weeks of unemployment insurance that are part of this as well. So that's also good news. Since I live and play here in New York, I was looking at the New York State website as part of this, and they have a really good chart out there that shows you. And I hate to be biased, but other states that have similar stuff that are out there or are getting out there. And hopefully it's as good as this, because I thought this was an excellent slide by New York State to show you what you can do for claiming this stuff. It shows you, let's say, you can look at that third box, from the left there, not traditionally eligible for UI benefits. So think of what I just said. Your self-employed people, your farmers, you apply down there in that big box, and then you're not eligible for that, but you apply under the Pandemic Unemployment Assistance Program. And that's going to be how you can navigate this system to get benefits under those programs as a self-employed individual. As I mentioned there's also that extra benefit of $600 per week available till July 31st here, 2020. And then you can see on the far right there, if you've exhausted unemployment benefits after July 1st here, you still may be able to get that extra 13 weeks if you follow these steps here to get that 13 weeks additional benefits of unemployment insurance that was extended as a part of the relief as part of all these bills. And again, I think New York State did a really good job here as well of putting out what does this mean for this new pandemic unemployment assistance? You can see right on their website there, when are you covered or when are you not covered? The highlighted portion there, you can see self-employed / independent contractors, 1099 people, farmers who are affected by this would qualify under the Pandemic Unemployment Assistance Program. All the other ones are kind of grayed out, but you can see if you're caring for somebody, if you're a member of a household who's been diagnosed, if you're seeking part-time employment but are affected by this, all those green dots on that left column there make you eligible for this type of relief. The only time you can't get it on that, the last two slides or points there at the bottom there, if you can telework with pay, or if you're receiving paid sick leave or other paid credit leave, regardless, right there of the meeting of the categories above, you won't be eligible for this PUA assistance here. I'm going to turn it back over here briefly for Tom Cosgrove, who is going to chime in on the Paycheck Protection Program and give a broad overview of this before we get into really get into the nitty-gritty next week's webinar on the 6th there. So Tom, if you want to unmute and ping in here for the Paycheck Program.
Sure, Dario. Can you hear me, Dario?
Loud and clear.
Great. So as Dario said, the focus of today's webinar is really on the tax and payroll provisions, and obviously a lot to digest there. Appreciate Dario's hard work in terms of digging through all the details to get them. A couple comments, and I've been monitoring questions as well during Dario's presentation, and there are a lot of them. One is that in terms of Dario's slides, on the GoToWebinar control panel, there is a handouts tab with a PDF of the slides. So those are there for reference. And then we are also recording this webinar. And so if you or others, we actually maxed out the capacity of our webinar platform for this. So we are recording this for people to, go over the portions of most interest to them after the fact, and we'll get that up on our website as soon as we can. But because it's such a topic of interest right now, we did want to just kind of briefly cover the Paycheck Protection Program. And as I said, we'll plan to host another webinar on Monday. Most lenders, Farm Credit East, we plan to participate. Frankly, we are still determining exactly how to do that. The SBA, while they announced that the program was going to be open starting tomorrow, as we've been monitoring their feeds, there are still some key details about how that exactly is going to happen. So, we will hold off in terms of outlining our plans on that for now. But just do want to give people just kind of a quick overview of what the program entails. Obviously, most folks with 500 employees or fewer are eligible. The loan amount is roughly the 2.5 times monthly payroll. There's some plus minuses there relative to other payroll expenses, and also some that can't be included. And as I said, I'm not going to get down into the weeds on that here today. I think the biggest thing that's attracted people to this program is the fact that it is potentially 100% forgivable, but that's only if after the closing of that loan that it's spent on eligible expenses, which is primarily payroll and some of those other items. But that could be reduced, the forgivable amount that is, if employee numbers or wages are reduced kind of year over year. The loan forgiveness would be reduced in a proportional amount. Very friendly from the standpoint of no fees, guarantees required, collateral. It is freely prepayable, attractive interest rate. But again, I think the hope for most people who are going to participate in this program that they would use it on eligible programs. So like I said, more details Monday. I think I'm going to turn it back over to Dario and Chris Lawton, who's going to monitor the questions, because as I said, we did get a lot of questions relative to the tax provisions. And again, I think Dario did a nice job kind of covering the interplay between that and the various relief forms that are out there that are a part of this. So with that, Dario, I think I'll turn it back to you, and Chris, for the Q&A.
Yeah, I'll kick it back. I got one more slide here to kind of just, again, to reiterate what Tom said, and then to go back to tying into the PPP with the employer retention credits that I mentioned. Again, remember with the employee retention credit, I don't want anybody to be confused about this point. You have to qualify for that credit based off of one of two criteria. Again, you're either been shut down by a government order, which most farmers will not qualify under that provision, or you're under 50%, as I mentioned earlier, gross receipts for the quarters based on 2019. But let's assume with Jack and Jill Farmer here, just to give a real 30,000-foot view on a hypothetical here, because we may have some people that fall into this category where they are eligible for both. It's not as clear cut on which one makes more sense. So look at Jack and Jill Farmer. They each have 30 employees. So again, remember what Tom said here. At its real basic level, the PPP loan is 2.5 times the average annual salaries for your employees. So you got 30 employees for Jack Farmer at $20,000 a piece is $600,000 of payroll expenses. Divided by 12 is $50,000 a month. So times 2.5 of that is, it's going to be $50,000 a month, $600,000 total expenses. That's $50,000 a month of payroll. Times 2.5 is $125,000 of PPP loan. But if you can see there, what would the employee retention credit yield? If you got 50%, up to $10,000, and they're all getting paid over the $10,000 there. So if you have, let's say $5,000 per employee, because that's what the credit max is, right? $5,000 if you do 50% up to the max $10K, that is going to be a $150,000 employee retention credit. So in a case where somebody does qualify for both, and again, really, you need to really, if you think about this stuff, really think about what your revenues are going to look like. So I don't believe most farmers, because they're eligible, they're not going to count into that piece. You have to look at your gross revenues and how low they may go for the year to think about this employee retention credit. But in Jack Farmer's case, if he's fully on board of this thing, by qualifying with the receipts test, then that credit is going to be a lot bigger in that case than the PPP loan. On the other hand, if we look at Jill Farmer, again, going through that same analysis there, where you're going to take the 50 grand of average pay, salary times the 30 over 12 months there times 2.5, you run those mechanics. Your PPP loan is a lot bigger than Jack Farmer's, because Jill Farmer has a higher average annual salary. So Jill Farmer's PPP loan is $312,500. So as I view kind of the takeaway as far as if somebody is potentially eligible for both of these things, then the program as written for PPP loans, it does favor the employers who are paying people higher. As you can see there with the math, that math makes it more beneficial for those employers who have a higher average annual salary per employee. But for those who are in the Jack Farmer category, and again, who qualify for the employee retention credit, which is a high hurdle, I want to keep pounding that into the ground so that there's no confusion there. Jack Farmer, potentially he's better off with the employee retention credit. Again, not getting into your taxes and then you're paying taxable income and stuff afterwards, but just looking at it from a purely 30,000 foot level here, you can see that it's not clear cut and dry for somebody hypothetically who is subject to both of these provisions that can qualify for both of those. But maybe let's say potentially even a good thing to know as far as as Tom is going to talk about next week here, the PPP loans are there's an X amount of money that are allotted for them. So if by chance somebody applies and doesn't get a loan per se, they may still have some benefits, and we need to maybe work hard and try to figure out if we can qualify for the employee retention credits in those cases. If that's the only option left for those people, we may want to look hard at trying to navigate our income to the best we can if it's under our control. So I just wanted to close that discussion with this piece there before turning it back over to Chris here. As we see the last slide that I'll point out here is if you go to our website, farmforpeace.com, Knowledge Exchange, you can see you click that, and then you click the COVID-19 Resource Hub. We have a whole page dedicated to what's going on and to the PPP loan, some of the articles I've written on some of this tax stuff, interest rate information there that people have questions on. So it's a great resource that I would encourage people to go to and check out on the farmforpeace.com/resource hub website under that Knowledge Exchange banner. And with that, Chris, we did pretty good on time. We got about 5 minutes left for questions. I will say I will do my best to answer them all. I will be frank, if I don't know the answer, I will tell you that, because I probably don't know every answer to everything, but I will do my best for the ones that I don't know to try to take those offline and get back to people so that we can get people answers. So Chris, I'll to you here for some Q&A.
Yes, we have a lot of questions, and I am going to say that we will be going a little bit past our 1 p.m. Finish time, if you will, just because this is important stuff and we have a lot of questions. We'll do our best to get to as many questions as we can. We may have to follow up with some people individually if we don't get to their questions in time, or if they're too specific. And yes, Dario, absolutely. This is complicated stuff. There's no shame in not knowing the answer to some of these things. If you don't know, that's fine to just say that. So in no particular order here, I will go through and just say, I'll just start with one here. If you take advantage of the tax credit and the Emergency Sick Leave Act, does that mean you cannot take advantage of other provisions in the CARES Act? That makes sense?
The question, yeah, if you're taking advantage of the employer retention credit that I mentioned, that 50% there, you cannot take advantage of the small business loan. So
I think the general concept is they want to avoid people. Oops, sorry, go ahead.
Yeah. The key is they want to make sure people aren't getting both benefits on both programs. Go ahead, Chris. Continue that thought there.
Yeah, I think a lot of these things are designed to prevent what they call double dipping. So, yeah, I think you need to kind of decide what, you can't get reimbursed for the same expense twice, in other words.
Yeah,
so
correct. A general rule for a lot of these things as people are looking at them is if you're getting a double benefit, somewhere, that's probably not going to be allowed for that. And that's very particular here with the employee retention credit. You cannot do that with the SBA loan. You cannot defer your payroll taxes, as I mentioned earlier, with that payroll part of the CARES Act. You cannot do that and also get the loan forgiveness under the SBA loans.
Okay, thanks. So going all the way back to the individual coronavirus mitigation payment, whatever you want to call it, the stimulus payment, it's $1,200 for individuals, taxpayers, reduced obviously for high income filers, and then $500 per child. Do you know what the limits are for children in terms of age, and they have to be declared as dependents, I assume?
Great question there. So it is based off, I believe it's 17. It works exactly like the child tax credit does. So for those that can get the child tax credit, you are eligible for that. I know that's caused a lot of I guess consternation on some of the people I follow and read on Twitter as far as the way they declare dependence there. It does mirror the child tax credit. So it's that 17 age cutoff that people are familiar with as far as the child tax credit goes. That's going to be what they're basing that off of. And I'll add to that, Chris, that from let's say maybe you have a kid who's a dependent, they went to college last year, they're done with college, they may want to file 19 now, because if they're not a dependent now in 19, they may get a better bang for the buck getting that $1,200 because they're no longer a dependent. And I failed to mention, which I should mention now, dependents don't get their own $1,200 here. So if you're a dependent, as I just said, like a kid at college as a dependent of their parents, they would not be eligible for these payments here. So you cannot be a dependent and get the payments coming through. You have to not be that. You also have to have a working Social Security number. You can't be a non-resident alien individual, an estate or trust.
Okay, and are those income limits based on gross income or net personal?
Those were adjusted gross income limits at the individual level. Being a taxpayer, if I can show you back all the way. I'll go back to the slide 1 here. It's your adjusted gross income of taxpayers that are looking there. So you think about your adjusted gross income. What does that mean? You think of your tax form, your 1040 form. You have all the income that you have there. Then you have things that are reductions against gross income. So all those things potentially that may be going on there. But line 7 there is your AGI limitation there. So you look at your tax return, find the line that says adjusted gross income, because it starts with AGI, then you got some other stuff that reduce that to get a taxable income, but your AGI comes first. So look at your adjusted gross income at the individual level to figure out what your numbers are. And again, if you haven't filed your 19th return yet, and you think you're going to have a much higher income than 18, I would hold off filing your 19 tax return. On the flip side of that, I'll just add here, I know a lot of farmers, particularly in New York State, you get a lot of tax refunds. Farm Credit East tax staff, we're all working remotely, business as usual here, and we are filing your returns to get you those refunds. So you still may want to file your New York State return, get your refunds, but perhaps delay your payment of your federal stuff until July 15th.
Okay, and the example here talks about 2 children. If you have a big family, is there a limit on the number of children you can get the benefit from?
I don't know, Chris, if they cap that out above that. They may have. I can't say with certainty. I believe it's per child, but there may be a cap, but I'm not aware of that yet. I haven't needed to dig into that.
Okay, and legally, I read somewhere that this is the legal framework for this is that this is an advance on a 2020 refund. Would the stimulus payment reduce your 2020 refund?
Great question there. So yes, it is an advance on 2020, but as I mentioned here, it worked really, really interestingly where from if you got a big payment in 19, let's say, and your income in 20 was lower, they are not going to reduce your refund. So it only goes one way. It's very taxpayer friendly. If you got less of a credit in 19, but then you have lower income in 20, you can get they'll boost you up, but they won't take you back. So it goes back to my point of really looking at tax planning here, because you can only benefit from the advanced credit. You cannot be reduced back. So we may want to look at tax planning opportunities as well for that. Great question there. It's come up a lot, but surprisingly, as the bill is written, there is no quote unquote, as I say, clawback. They can only give you more benefit in 2020.
Okay. A question about accessing retirement account funds. Is there a time limit when that expires?
It's for 2020. So they implemented that for the 2020 tax year. After that, when you get beyond 2020, it expires then. So if you're looking about taking money out of a qualified retirement plan, you should do that in 2020 because you won't be able to do it after that.
Okay. Another question here is the student loan payments. You mentioned that businesses can advance up to, what was it, $5,250 or something like that?
$5,250
for their employees' student loans. Is that a deductible business expense for the employer?
Yes. So they did they've laxed the rules there. I believe that is going to be still an expense for the employer. They've made it a little bit more expansive in that regard because as people whoever asked the question probably knows that there are some kind of stringent rules historically with some of that stuff, but they should be able to get an expense there and also have on the employee side tax-free income for that recipient there of $5,250.
Okay, moving on. We had some questions about business interruptions. Even if your business is essential, but you've chosen to close because of this crisis, or for other reasons, perhaps part of your business is non-essential, or perhaps you have employees that got sick. Do those things qualify you for business interruption?
Do those? It's got to be, it's got to be fully or partially suspended. The way it reads is the employer's business is fully or partially suspended by government order. So I would interpret that, as I looked at it, you're right, I'm reading from the IRS website right now, as the government made you do something. So if you could still operate, but you're not, then I don't think I would say you've been fully or partially suspended by the government order, because it specifically notes in that interruption there for the employee retention credit that you're fully or partially suspended by government order. So in that case,
but there's also that income provision where if your income is reduced by half or more, so wouldn't that take effect?
Correct. So yeah, for the employee retention credit, in order to qualify, you have to fall into one of two categories there. You have to have your business be either fully or partially suspended by government order, or as I showed you with the slides there, your gross receipts are below 50% for the comparable quarter in 19. So if you fall into the category of you've kind of shut down, but you're still able to work because you're essential, you'd have to go under the 50% gross receipts test to qualify for the employee retention credit.
Okay. So moving on to the Employee Emergency Paid Sick Leave Act and the PPP, we do have some larger employers that may be affected by the 500 employee limit. Do you know how that's calculated? Is it current number of employees, or is it average for a certain number of weeks in the past?
Yeah, so they do have that up there. Let me see if and I'm going real time with you guys here, but they are looking at it says if you employ fewer than 500 full-time and part-time employees, and it does count. An important point with that is it does count jointly employed employees, and there are certainly attribution rules there as far as if you have people who are perhaps working with a common employer or joint employers there, as far as aggregating the integrated employee test there. So you need to look at, at those very, very closely there. There is a great, for people to take a look at there, if you go to the departmentoflabor.com website, on the Q&A, the first two questions there do specifically deal with, and you can see if I put that on my screen here as I'm going real time with everybody, it goes into how do you know if your business is under the 500 employee threshold and must provide paid sick leave there. So there's a lot of some nuances there as far as what I mentioned as far as being joint employers, employees, that I would certainly take a look at, in that regard.
Okay, and then we had several questions relating to temporary, seasonal, and 1099 employees. So just to go through some of those, for seasonal employers, which is a lot of our customers, how do we calculate the number of employees or the payroll for these relief acts?
Yeah, so good question there. So you have part-time employees certainly, and again, as I'm going real time with you guys here on the webinar too. You look at question 5 does a good job from the Department of Labor. How do I count work for a part-time employee? You look at, as I mentioned, based off of the average number of work in a 2-week period. You figure your leave based on that. If the schedule varies for these part-time employees, you can use a 6-month average to calculate the average daily hours. And those employees may take paid sick leave for this number of hours per day up to a 2-week period. It can also take the expanded family medical leave for the same number of hours per day up to 10 days. Another point there, you can see me highlight here on the screen. If you can't do this because the employee's not been employed for at least 6 months, use the number of hours that you and your employee agreed that the employee would work upon hiring. And if there's no such agreement, you can figure this, the appropriate number of hours based on the average hours per day the employee was scheduled to work over the entire term of his or her employment. And then kind of dovetailing off that, you can see question 6 there. You have to also count in overtime there. So again, we'll direct you to all these resources, which we have on our Knowledge Exchange website here. But the DOL, Department of Labor, has done a really, really good job, in my opinion, on giving employers a lot of great Q&A on this stuff.
Okay. A couple specific questions on the PPP program. What about 1099 employees? It's my understanding that those are included in that, correct?
I'll defer those to Tom or Keith if they want to chime in on the PPP stuff here.
Hey Dario,
Okay.
I don't know on that one. Let's save the PPP questions for Monday and stick to the other tax-related ones.
Oh, okay, fair enough. Another question is, do you know about how the wage calculation works for tipped employees? Is it based on their declared wages and their tax returns, or how does that go?
So there are some stuff on here for tipped employees too. Is what is my regular rate of pay? If you're thinking about the Family First Corona Response Act, you can see if you're paid with commissions, tips, or piece rates, these amounts will be incorporated in the above calculation. It's to the same extent they are calculated in the regular rate under your FLSA. So yeah, tip people do have ways to look at that as well.
Okay. We have a couple of questions about that, again, relate to seasonal employees. What happens if an employee that FMLA would cover hasn't yet worked for you for 30 days? And then on the back end, if you have an employee that was seasonal and was only supposed to work for a limited number of months, are the employers still required to pay for full 12 weeks of leave, even if it extends beyond when they would have left?
Great questions there. I don't entirely know. So there are a lot of H-2A issues with this stuff too. Like for example, with with some of these tax credits there, if you're not paying employer credits anyways, for these things on H-2As, there's no credits on some of these things. But there are, and I don't want to get into H-2A stuff there, but as you contract with H-2A people, you have to guarantee them, 3/4 of their, of their contract, and so there's a lot of weird stuff that goes on with H-2As, and having to navigate that I say we'll take offline, because it's the H-2A part of this thing here is really nitty gritty. But we're still waiting guidance from New York State on how exactly they're going to implement some of the stuff with that, with regard to some of those folks.
Okay. Another question was about pandemic unemployment insurance, the additional unemployment benefits. Those are things that the unemployed former employee would apply for themselves, correct?
Yeah, correct. So the pandemic stuff, the unemployment insurance, the employees would apply for. If you're self-employed, they created that pandemic unemployment insurance, for self-employed people who generally are not eligible for unemployment insurance. So if you're a self-employed person, yes, you would go apply for that on your state's respective website. New York State, I know they have, if you go to their, COVID-19 part of the DOL site, they do have a nice PDF I was reading this morning on how to go about logging in and claiming unemployment insurance. You can certainly reach out to your Farm Credit Payroll helper to assist that if you have questions there. But they do have some good guidance out there, and I'm sure all states do. I just know New York, intimately here with applying for unemployment insurance.
Okay. Do you know if that's considered taxable income?
Yes, I believe unemployment insurance is taxable income.
Okay. Couple of questions, and again, if you don't know the answers to these precisely, that's fine, because this gets complicated. But H-2A workers, I know that this is difficult and complicated to figure out, but I believe that they're not eligible for like employee retention credits because they're not permanent residents of the U.S. But do you know if they would be counted as part of your average payroll?
Great question, Chris. I don't know the answer to that question. As you pointed out, the H-2A people are not paying those employer credits. There's no credit to get from them, in that regard there. So we're not going to be able to claim a credit on wages that are on taxes that we're not paying for them. And then as you guys get into Monday with the PPP stuff, there are some H-2A issues there too, and not being able to be eligible. So yeah, H-2As are its own piece there, where if you're not paying tax on them, you really can't get a credit for stuff you're not paying.
Okay. What about employees or self-employed individuals, perhaps individual farmers, that have taken pay cuts or hour cuts? Would they be eligible for unemployment compensation for the lost portion of their wages?
I would say they certainly could be here. So I think as we look at that slide I showed you as far as New York State's banner there, it says you've been affected by COVID-19 now. Will they kind of flush it out a little bit? Hopefully, but it looks like the way their poster reads, and again, unemployment's all state specific, so check your states as they are the administrators of the unemployment insurance. But New York State says if you've been affected by this and you've had to cut back and stuff, then you probably you can navigate that and get something. I would suspect.
Okay, I'm just scrolling through some of these many questions that we have. For employee retention credits and that sort of thing, what if you've already laid off some of your employees?
So if you've laid off people, again, that's not gonna help you with the employee retention credit, because you can see on the screen here, it's for wages paid, after March 13th there through the end of the year. So if you've laid somebody off, they can go on the websites for their states and collect unemployment, but you're not paying wages as of March 13th through the end of the year there. So it's only for people that you've stayed on, and the goal of this again is to keep employers having people on the payroll there. So if you're laying people off or have laid people off, then certainly they will not be part of this calculation.
Okay. so now there's reimbursement for sick leave under the under one of the provisions of the coronavirus relief. Now, my understanding is that that's not eligible for other reimbursements or that sort of thing. Is that making sense to you? It's just a complicated issue.
So not necessarily. So if you're getting the family first act there, the FFCRA stuff, you could also potentially get the if I go back to see if I a slide here, you could also potentially get the credits, but you just can't get them on the same wages here. So for example, if you're claiming the employee retention credit, can you also get the credits for the FFCRA tax credits? The answer is yes, but just not on that same wage amount there. So, as long as you have additional wages there, in that regard, you could be able to navigate, getting both credits under the Family First Corona Response Act, as well as the employer retention credit.
Okay. One question would be that came up is, what about workers who are still employed, or perhaps they're working for an essential business that quit because they're afraid of coronavirus? Would they be eligible for unemployment compensation?
If they quit, so yeah, if you look at and some of the stuff is great out here for New York State, but if you look at what would be covered, you've been diagnosed with COVID, your household's been diagnosed, if you have to provide care for somebody, if you're seeking part-time employment, but you've been affected by this, potentially there's a lot of ways under your each respective state that what's covered that they're putting out guidance on. So I would say go to your state's website, look at New York State for this example here. If you fall under one of these things here, then certainly if you've quit work because this has affected you, then you probably should be able to get some of this stuff. I think is the only X's I see at the bottom here are individuals that are still teleworking with pay or receiving paid sick leave. So maybe you've had to quit because your kid's at home and you're like me, my daycare's closed. My wife and I are both working from home. We wouldn't count because we're still working, but if we weren't working, if I had to quit my job to watch my child, that would be impacting me.
Mm-hmm. And then one question to ask you to put up that Department of Labor Q&A link again. You went through it rather quickly when you went onto your web browser.
Oh, sure, and I can, and we'll try to link these. You'll certainly link these things for everybody as afterwards here. But and I appreciate everybody bearing with me here in real time as we go through this stuff. But you can see at the top here, this is a really, I really would suggest and encourage all employers. Our goal here at Farm Credit is to get you all the information possible to help you make the best decisions. And this DOL.gov website /agency/WHD/pandemic/FFCRA-questions is really just excellent. I think they do a really phenomenal job on a lot of this Q&A stuff here. So I'll leave this up on the screen here, for a few seconds here while Chris continues to field stuff so people can jot this website down, which again, we will link to and have linked to all these websites on farmcrediteast.com under our Knowledge Exchange COVID-19 page there. Are you still there, Chris? Is there anything else left on the pike?
Yeah, sorry, I muted myself for background noise and I forgot to unmute. Apologize for that. Couple of questions came in about owner's pay. If you're a W-2 employee, you're working for an entity like an LLC or a corporation, you'd be not just treated like any other employee, I assume. What about if it's a like sole proprietor or a partnership?
So if you're a sole proprietor, you are going to be eligible for all these things. Do have sole proprietorship things in them. So as I mentioned with self-employed people, as far as the employer tax credits go, for example, self-employed sick leave credit, you are still going to be able to get your own credits here if you're self-employed, based off of the formula on the screen here. Or again, if you have if you have for the Family Medical Leave Act, if you're taking a part of that, you also get credits for that. And the good news is that you're working with your tax preparers here. We'll help you work through this on your income tax return, because that'll be for self-employed people. The credits for the sick leave and FFCRA stuff, those will be for your income tax return in 2020, and we will help you navigate that as we work with you in that.
Okay. Question came up about your farmer decisions table in your presentation, and regarding the if the employee retention program is capped at $10,000 per employee, they were confused at how you were getting to your total there.
So it's the analysis is it's 50% up to the $10,000. So the way if I go back to the employee retention credit for a moment here, we can see that the credit is 50% of wages paid per employee up to $10,000. So I can your great question there is the person is asking is how do you get to that? So if you're paying somebody 10 grand, let's say, your credit's going to be 50% of that number. So basically, if anybody's over 10 grand that you're paying with their health benefits there, it's 5 grand per employee, because it's 50% up to the 10 grand cap there. So hopefully that helps answer the question on the employee retention credit, because this person's got 30 employees, right? Jack Farmer here. They're all making over 10 grand. So if we do just 50% of 10 grand for each employee, so 5 grand per 30 people, we got 150 grand of an employee retention credit.
And that's for what time period?
The employee retention credit, as I mentioned, that is for wages paid now. So going back to the person's question who asked about if you laid people off, again, this is for wages paid March 13th through 12/31. So basically goes through now through the end of the year here. Wages that you pay, you're going to get a 50% credit up to that 10 grand, as I mentioned there. And again, you just got to be careful. As I don't want anybody on this call to not apply for like a PPP if they think that this is better, if they don't qualify for this program of the retention credit. So just be really careful, work with your professionals to see what's best for you there. But it's for March 13th through 12/31.
Okay, in aggregate, not per month or per quarter or anything.
Well, no, those as you're paying those refunds do come per quarter. So those refunds are going to be received quarterly there. And again, going back to my example, let's say as you're doing your quarterly payments here, you're going to be able to keep some of that money as opposed to remitting it to the government there. So the employee retention credit is a quarterly system where you can keep the money that you're otherwise required to pay because that credit's there. So back to my example of 10K of wages with a 5K credit, if you're required to keep 8 grand, or if you're required to deposit 8 grand, you can keep the 5,000 penalty free there as long as you're remitting the 3 grand that you have to otherwise to the government. And then you are going to account for this on your quarterly filings, your 941s, 943s.
Okay, yeah, I was just asking more specifically about the $10,000 cap, if that's per some time period like monthly, or if that's just a cap for the aggregate period.
Yeah, I believe that's just a cap there for the worker.
Okay. Another question, again, just getting back to the seasonal employee issue, because it's a little bit complicated and it's important for many of our listeners. Would you base your payroll on when people would normally start working, or how would that work for people that perhaps haven't really started their season yet?
Yeah, great question there. I don't know how helpful I can be there. I would say, as I look at the slide here in front of you, on when people are eligible. So as I think about the FMLA Expansion Act, after 30 days of employment, or the Emergency Paid Sick Leave Act immediately. So I would say there, good question that we're in the process of trying to flush out some of those as regulations continue to unfold there. We get more guidance. So stay tuned as that becomes clearer. We'll certainly provide that information in updated postings on our blog.
Okay, and so for these these retention credits, will this start affecting their 941 returns as early as this month?
Yes. So they should be. These credits. It looked like the employee retention credits here. It's as I go back to for wages 313 through 1231. I believe the answer to that is yes. I'm eager to see what the government does as far as updating their forms here. But if you paid wages here, through 313 on here, then I think they're going to have to give some kind of guidance on how that's going to how that plays out here with what's going on and how to do this.
Okay. So we've gotten to most of the questions that came in. I apologize to a few of you that we weren't able to get to. We've gone significantly past our stated stop time, so I think we need to kind of cut it off at this point. But just a few things. We will be having a webinar specifically entirely about the PPP program on Monday, and we will be sending out a link on that to register for that because that's a whole thing unto itself. And we will be posting additional information on the COVID-19 resource page at farmcrediteast.com. There's a tab for that. The recording for this webinar, as well as Dario's slide deck, will be posted at farmcrediteast.com/webinars. And that's where all of our webinars, past, present, and future, reside. And with that, I think I will thank Dario very much for his time. We will follow up with some of you offline, and I think we're going to adjourn.
Thank you, Chris, and I appreciate everybody spending the last 90 minutes with us. We hope it was valuable to you. Thank you.
Thanks a lot, Dario.